So imagine for a second that you're looking at this massive dynamic map of the global economy.
Okay, I'm picturing it.
But instead of showing countries and borders and all that, this map only shows the physical flow of money.
Right, just the capital.
Exactly. And historically, you'd expect those currents to look, somewhat predictable, like rivers naturally flowing toward the ocean.
Sure, yeah.
But if you look at that map right now today, the currents are acting completely erratic.
Oh, totally, it's wild.
Right. You'd see these massive, blindingly bright clusters of capital just glowing around physical data centers right here on Earth.
Yep.
And then you'd look over at Japan and see the financial tectonic plates suddenly shifting, just violently reversing a 30-year trend.
The total reversal, yeah.
And then, maybe the most jarring part of all, you'd see this giant trillion-dollar beam of capital shooting straight up into orbit.
That is a phenomenal mental image. It really is.
Way.
No, but it perfectly captures the structural rewiring we are all living through right now. Because to the untrained eye, those look like isolated anomalies, right?
Right, just random events.
Exactly. But in reality, they are completely intertwined gears of the exact same machine.
Which is exactly why we are pulling this all apart for you today.
Sure.
We actually got our hands on a really dense, high-level financial intelligence brief
The KGI CIO Office Global Markets Weekly Kickstart.
from December 2025. Yes. And we're treating this document as our ultimate cheat sheet for this deep dive.
Okay, gold mine.
It really is. So our mission today is to strip away all that opaque financial jargon, and just show you the underlying mechanics of where the smartest money on Earth is actually flowing as we push through 2026.
Because, it is incredibly easy to get lost in the basis points and the ticker symbols when you're reading market intelligence.
Oh, for sure. Your eyes just glaze over.
Right. But if we pull back and look at the actual physics of this capital, how tech earnings, central bank policies, and aerospace engineering are all reacting to each other.
Yeah.
A single, highly connected global narrative really emerges.
So let's start right where the money is making the most noise. Terrestrial technology.
The AI infrastructure boom.
The AI boom, exactly. Just recently, there was this absolute panic in the markets over tech earnings.
Oh yeah, it was tense.
People were genuinely terrified that the AI bubble was finally popping, mainly because major players like Oracle and Broadcom, they started showing softer margins.
The anxiety was palpable. And to be fair, it stemmed from a very logical fear.
How so?
Well, the market was essentially asking the structural question. We are spending hundreds of billions of dollars to build artificial intelligence, but where is the actual tangible return on investment?
Where's the cash?
Right. Oracle had weak backlog to revenue conversion. They had this mountain of orders for cloud infrastructure, but they physically couldn't turn those orders into cash fast enough.
Because of supply bottlenecks, right?
Exactly. Supply bottlenecks. And at the same time, Broadcom's margins were softening, so investors started to sweat.
They were wondering if this whole AI build-out was just a build it and they will come fantasy.
Yeah, where nobody actually shows up.
But then Micron released their earnings, and the entire narrative just flipped overnight.
Flips completely. They didn't just beat expectations, they absolutely obliterated them.
They guided for an earnings per share of around $8.40.
Which is huge.
The broader market had priced in something closer to, what, $4.70, $4.80?
Yeah, around there. Almost double what everyone expected. But the crucial detail wasn't just the profit. It was the specific hardware driving that profit.
Right, the high bandwidth memory.
Exactly. Their high bandwidth memory capacity is fully booked all the way through 2026.
Wow, sold out.
Completely. And high bandwidth memory, or HBM, is the perfect metric to track here. Standard memory chips work fine for normal computing,
Like a regular laptop.
Right. But when you are training a massive AI model, the processor needs to access oceans of data instantaneously.
So what does HBM actually do differently?
It essentially stacks memory chips vertically.
Yeah.
It creates this incredibly wide, multi-lane highway for data to travel straight into the AI's brain, so to speak.
Oh, okay.
And the fact that Micron is sold out of this specific hardware for the next 2 years proves the end demand isn't speculative.
It's urgent.
It's urgent, and it is very real.
Which perfectly sets up this staggering data point from JP Morgan. They tracked this custom index called the AI 30.
Yep.
It's the 30 companies in the S&P 500 most directly responsible for building this entire ecosystem. And by mid-2026, Those 30 companies are projected to spend over $550 billion in capital expenditures.
That is nearly double what they spent in 2024.
It's
A
insane.
$500 billion physical build-out in just a few quarters.
I try to process that number, and I keep thinking about the building of the Transcontinental Railroad.
Oh, that's a great analogy.
Because first, you enter this terrifyingly expensive phase where you are just laying down the tracks, right? You're blasting through mountains of granite, laying millions of tons of steel.
Spending an absolute fortune.
Yeah. On paper, it looks like you are just bleeding cash into the dirt. That is the $550 billion in capital expenditures. You have to lay the tracks before you can run the highly profitable freight over them.
Exactly. And we are currently blasting through the most expensive mountains of compute power in human history.
Right.
But the freight is finally arriving. Despite that historic level of spending, the net margins for the AI 30 are projected to hit 25.8% by 2026.
25.8. Wow.
Yeah. And if you compare that to the rest of the market, the other 470 companies in the index,
What are they at?
those legacy businesses are averaging a net margin of just around 11%.
Wow. So more than double.
Easily. The companies laying the track are extracting vastly more profit from every dollar they touch.
I do have to push back on one element of their financial strategy, though, because it's bugging me.
Sure, go for it.
These AI-led tech firms are executing massive share buybacks. They're exceeding $300 billion in buybacks for 2 consecutive years.
Yeah, that's a big number.
Right. If these tech giants are dropping $300 billion just to purchase their own stock, does that mean they're running out of new things to invent? Like, are they just artificially propping up their stock price because the innovation well is running dry?
It is a really common criticism,
Mm-hmm.
but you have to look at the mechanics of return on equity here.
Okay, unpack that for me.
When a company buys back its own stock, it destroys those shares. It reduces the total number available on the market.
Right.
That automatically makes every remaining share more valuable because it represents a larger piece of the company's earnings.
Mm-hmm.
In this specific macro environment, it's not a lack of innovation.
Because they're still spending the $550 billion.
Exactly. They're still deploying that $550 billion into pure research, development, and servers. The buybacks are just a brutal flex of their cash flow generation.
Ah,
They are generating so much pure cash from their structural growth that they can afford to build the entire Transcontinental Railroad and buy out their own shareholders at the exact same time.
okay, wow. That puts it in perspective. Which brings us to a fascinating inflection point in our deep dive,
Yeah.
because once you finish laying the tracks across the entire continent, you eventually hit the ocean. You run out of terrestrial real estate.
You do.
And the markets are already anticipating this. They are looking past the earthbound data centers, and they are pouring capital into the orbiting economy.
The commercialization of space is, it is no longer science fiction.
Not at all.
It is rapidly becoming a core macroeconomic growth driver, and it's operating with the same brutal financial logic as the tech sector.
And at the absolute center of this is SpaceX. They're reportedly targeting an IPO in 2026, looking to raise over $30 billion.
Yeah.
The implied valuation being discussed is somewhere between $800 billion and $1.5 trillion.
Trillion, with
Yeah.
the T. And looking under the hood at the ownership structure is incredibly revealing because they are private. The exact cap table is closely guarded, right?
Right.
But estimates show Elon Musk holding about 42% of the equity while maintaining roughly 80% voting control.
Total dictatorial command over the largest aerospace entity on Earth.
Pretty much.
Yeah.
But look at who else is at the table. Alphabet, Google's parent company.
Right.
They hold an estimated 7% stake.
Oh, wow.
So for institutional investors trying to get public market exposure to SpaceX's growth before the IPO actually happens, Alphabet is essentially functioning as a backdoor proxy.
That is so smart. But the detail that really shifts my understanding of the space economy is where SpaceX's revenue actually comes from today.
Yeah, this is key. For
For our entire lives, NASA has been the undisputed face of space exploration. But by 2026, NASA will account for less than 5% of SpaceX's revenue.
less than 5%.
They are a deeply profitable commercial enterprise without relying on state-sponsored exploration.
The paradigm has entirely shifted. Space is no longer about exploration. It is about infrastructure.
Infrastructure.
Right. The revenue engines driving that $1.5 trillion valuation are Starlink's global internet coverage and the imminent commercialization of the Starship program.
Starship is the massive rocket, right?
Right. Starship fundamentally changes the physics of aerospace economics. When you introduce a fully reusable heavy-lift rocket that can fly almost every single day,
The cost just
it
plummets.
drops exponentially.
Yeah.
The cost to put a kilogram of infrastructure into orbit just crashes. It transforms space from a bespoke, high-risk venture into a standardized logistics lane.
And the defense sector is clearly adapting to that new logistics lane. Global military expenditures grew 9.4% in 2024,
Oh,
which is the fastest growth rate since the end of the Cold War.
and that rising tide is lifting specialized pure-play space companies. Rocket Lab is a great example here.
I've heard of them.
They provide end-to-end space services, and they are pulling in record revenues, 155 million in a single quarter. That's up nearly 50% year over year. They are launching their new reusable medium-lift neutron rocket specifically to capture the satellite demand that SpaceX can't absorb.
They're catching the overflow.
Exactly. Even legacy industrial giants are pivoting. Honeywell is actively spinning off its aerospace division
Really? Why?
because the profit margins and the market valuations in the pure-play space sector are vastly superior to traditional industrial manufacturing. They want that multiple.
Let's follow the logic of that 5% NASA figure, though.
Okay.
Because if space is rapidly shifting from a slow, government-funded model governed by international treaties into a purely commercial trillion-dollar gold rush,
Right.
who regulates this when a single private individual holds 80% voting control over the primary logistics lane to orbit? A lane that the global military and commercial sectors now completely rely on?
It's a huge question.
Market forces are suddenly superseding political ones.
And that is the defining geopolitical question of the decade. We are flying completely blind into new regulatory territory. The primary legal framework for orbit is the Outer Space Treaty of 1967.
1967, so the Cold War.
Exactly. That treaty was designed by nation-states to prevent other nation-states from putting nuclear weapons on the moon.
It wasn't designed for commercial broadband satellites.
Not at all. It entirely failed to anticipate a reality where a single private corporation wields significantly more launch capacity and orbital infrastructure than entire superpowers combined.
Wow.
The market is just moving way faster than international law can adapt.
So we have these colossal capital requirements. $500 billion for AI data centers on Earth, and potentially trillions for communications and defense infrastructure in space.
Yep.
This brings us back down to the fundamental mechanism running the world. How is the global economy actually financing all of this?
And the answer depends entirely on which continent you are standing on.
Right.
We are entering a period of massive monetary divergence. The central banks of the major economies are pulling levers in completely opposite directions, and it is dictating where all this infrastructure gets built.
Okay, let's bring that down. In the United States, inflation is cooling much faster than anticipated.
Thank goodness.
Yeah. The consumer price index dropped down to the mid-twos. And because inflation is increasingly under control, the Federal Reserve is shifting its crosshairs.
Right, they're pivoting.
They are less worried about prices and much more concerned about a cooling labor market.
Yeah.
So to stimulate hiring and investment, the expectation is that they will execute multiple rate cuts in the first half of 2026.
Yep.
Bonds are rallying. The cost of borrowing money in the U.S. is getting cheaper.
And cheaper capital in the U.S. acts as a massive structural tailwind.
Okay.
When borrowing costs drop, it becomes vastly easier for those top 30 tech companies to finance their $550 billion in capital expenditures.
Oh, obviously. That makes sense.
But if you look across the Pacific to Japan, the mechanism is running in absolute reverse.
Yeah, this is wild. The Bank of Japan just raised rates by 25 basis points, pushing their core policy rate to 0.75%.
Right.
Now, to an American listener, 0.75% sounds essentially like zero.
It's nothing here.
But in Japan, that is a seismic shock to the system. They decisively shattered a 30-year ceiling where rates never crossed 0.5%. Cumulatively, this is the tightest monetary policy year Japan has seen since 1998.
And we really have to unpack how critical this is to the global tech boom.
Please do.
Because for decades, Japan has been the world's premier source of practically free money. It fueled something called the yen carry trade.
Okay, let me see if I can map the mechanics of this out for the listener.
Go for it.
If I am a massive global hedge fund For the last 20 years, I could go to Japan and borrow 1 billion yen at basically 0% interest.
Free money.
I then convert those yen into US dollars, and I dump that $1 billion into high-yielding assets, like the exact American AI tech stocks we've been talking about.
Exactly.
I harvest the massive returns from the tech boom, I easily pay back my zero-interest yen loan, and I just pocket the vast difference.
That is the exact mechanism. But it completely breaks down when the Bank of Japan raises rates.
Because the currency changes.
Right. When Japanese interest rates go up, the yen becomes a more attractive currency, and its value strengthens against the dollar.
So suddenly, the cheap yen I borrowed years ago is incredibly expensive to buy back today.
Exactly.
My free loan just became a toxic liability. So I am forced to sell off my American tech stocks just to cover the margin call and pay back the Japanese bank.
Precisely. And that is why Japan raising rates by even a fraction of a percent causes violent short-term pullbacks in global tech equities.
The money is being sucked back to its source.
Yes. However, the overarching consensus is that the structural, long-term demand for artificial intelligence is so overwhelmingly strong that it will ultimately absorb and override the friction caused by unwinding the yen carry trade.
That makes sense. The AI demand is just too big.
Way too big. And interestingly, inside Japan, this policy shift is fantastic for domestically focused assets.
Like what?
Japanese banks and real estate investment trusts. They are surging because they benefit from the improving domestic economy, and they aren't hurt by the stronger currency.
Wow, okay. And then China is executing its own massive pivot at the same time.
Yeah, totally different direction.
The 2025 Central Economic Work Conference made it clear that they are abandoning the old playbook. They are no longer relying on broad, band-aid fiscal stimulus just to hit arbitrary GDP targets.
Right.
Instead, they are entirely focused on domestic demand-led growth.
It is a very deliberate shift. They are moving away from artificially subsidizing the broader economy and aggressively optimizing the supply side.
So making better products.
Exactly. They want to remove institutional red tape and force companies to innovate and create higher quality products that Chinese consumers actually want to purchase organically.
And this heavily benefits domestic retail players like China Merchants Bank, who are perfectly positioned to capture the rebound in consumer lending.
Yep.
But it goes deeper than just consumer spending, doesn't it? The strategy heavily emphasizes AI empowerment to achieve total supply chain self-reliance.
Yes.
They are pushing for end-to-end localization of advanced technologies so they aren't reliant on Western infrastructure.
Which brings us to the harsh physical reality of all these grand macroeconomic theories.
The hardware.
The hardware. You can have all the cheap capital from the U.S. Federal Reserve, and you can mandate all the supply-side optimization in China. But if you don't actually manufacture the physical hardware, it is all just abstract theory.
Someone has to actually build the picks and shovels.
Right.
And right now, the most critical bottleneck in the entire AI revolution is sitting in Taiwan.
Because the primary constraint on artificial intelligence isn't necessarily the raw computing power of the chips themselves.
It's the bandwidth.
It's the bandwidth. It is the physical speed at which those chips can communicate with each other across a vast data center.
Right now, the industry standard relies on 400 gigabit Ethernet switches. But to handle the incomprehensible data loads of next-generation AI, data centers are being forced into this massive upgrade cycle to 800 gigabit switches.
Which will become the baseline in 2026.
Yeah, and eventually they have to push to 1.6 terabit speeds.
Let's explain what that upgrade actually requires at a physical level, because it's fascinating.
Go ahead.
When you try to push that volume of data through traditional copper cables, the electrical resistance generates massive amounts of heat.
Oh, I bet.
It is like trying to force a fire hose of water through a cocktail straw. The friction is overwhelming.
So copper just melts.
Essentially, yeah. So Taiwan's supply chain is solving this bottleneck by moving the industry away from copper entirely.
Into optical transceivers and silicon photonics.
Yes.
So if I have this right, instead of pushing electrons through copper wire and generating all that heat, silicon photonics translates the data into pure light and shoots it through fiber optics.
Exactly.
So no electrical resistance, no friction, vastly lower power consumption, and exponentially higher speeds.
You nailed it. And companies in Taiwan, like Acton and Elite Advanced Laser, they are positioned as the absolute backbone of this transition.
They're making the plumbing.
They are manufacturing the physical plumbing that prevents the AI revolution from just grinding to a halt.
And we see a similarly fascinating evolution of physical hardware over in China with a company called Lens Technology.
Oh, yeah.
Traditionally, they are known as a legacy supplier of smartphone components, but they are aggressively pivoting their entire business model to jump into the AI server supply chain. They recently acquired companies specifically to manufacture liquid cooling modules.
Because even with silicon photonics handling the data transfer, the sheer processing power of the servers themselves is generating so much thermal energy that traditional air conditioning inside data centers is physically incapable of keeping up.
It's just not enough.
No, you have to run chilled liquid directly across the chips to keep the facilities from literally melting down.
But the liquid cooling isn't even the wildest part of Lens Technology's pivot.
The robots.
The robots.
Ah.
They have just opened a dedicated robotics and intelligent equipment campus. They are rapidly scaling the production of humanoid robots, jumping from 3,000 units to 10,000 units next year. And they were supplying dexterous hands and highly complex joint modules to leading robotics firms in North America and China.
The industry refers to this as the emergence of embodied AI.
Embodied AI.
We are taking the vast, abstract intelligence being generated in those massive liquid-cooled data centers, and we are putting it into a physical form capable of interacting with the real world.
I have to play the skeptic here, though.
Okay, lay it on me.
10,000 humanoid robots sounds amazing if you are writing a sci-fi script. But contextually, in global manufacturing, Toyota produces 10,000 cars before their lunch break. Apple makes millions of iPhones a day.
Very true.
So 10,000 robotic units is an absolute drop in the bucket. Is this a real sustainable secondary growth curve for a manufacturing giant? Or is this just a shiny gimmick designed to attract investors who are blindly hyped on the word AI?
It is a completely valid skepticism. I mean, in absolute terms, 10,000 units is a rounding error in global manufacturing.
Right.
However, you have to look at the extreme engineering complexity of what they are actually building. Dexterous robotic hands and high-torque joint modules are arguably the most difficult mechanical engineering challenges in robotics today.
Oh, okay.
By proving they can manufacture these specific, highly complex components at scale, I mean, they're more than tripling their own output in a single year.
Yeah.
They aren't trying to generate massive revenue today. They are strategically securing the foundational dominant position in the global supply chain before the embodied AI market inevitably explodes over the next decade.
Get in early, lock down the hardest part.
Exactly.
So what does this all actually mean for you? Let's bring all these threads together for you. Think back to that map of erratic, glowing capital we started with.
Right.
We are watching a cooling labor market in the U.S. trigger interest rate cuts, flooding the market with cheaper capital. We are watching the Bank of Japan shatter a 30-year ceiling, violently pulling cheap yen back home.
And we are watching all of this shifting global wealth pour directly into an unprecedented $550 billion physical build-out of earthbound AI infrastructure.
While simultaneously funding a $1 trillion commercial land grab in orbit.
The overarching takeaway here is that the global economy is in a state of rapid, violent physical manifestation.
That's a great way to put it.
The abstract algorithms of artificial intelligence are becoming highly tangible realities. They are becoming silicon photonics manufactured in Taiwan, liquid cooling systems assembled in China, and dexterous humanoid joints being deployed onto factory floors.
So whether you are managing your own retirement portfolio, working directly in the tech sector, or just trying to logically process the daily news cycle, understanding where this physical infrastructure is actually being built right now gives you the ultimate cheat code for navigating the next 10 years.
You follow the infrastructure, you follow the future.
Exactly. Which brings us to one final, deeply provocative concept derived from the intelligence we've been unpacking today. Something for you to genuinely mull over.
I love this part.
We talked about terrestrial data centers melting down from heat, right? And we talked about SpaceX making orbital logistics incredibly cheap.
Yes.
Well, the KGI intelligence briefly mentioned the theoretical concept of space-based AI data centers.
Yeah, wild.
Think about the physical logic of that for a second. We just established that earthbound AI is heavily constrained by the heat it generates, requiring massive liquid cooling systems.
Right.
And it is severely constrained by the limits of our terrestrial power grids. There's only so much juice.
Meanwhile, the vacuum of space provides infinite, absolute zero cooling and access to unfiltered, limitless solar power.
Exactly. The physics make perfect sense. But here's the thought I want to leave you with. If the physical infrastructure of artificial intelligence literally leaves the Earth to escape our power grids,
Yeah.
whose laws apply to the intelligence being generated in the vacuum of space? If an AI is thinking, learning, and evolving in orbit entirely beyond the sovereign borders of any nation on Earth.
Who actually regulates it?
Yeah. Exactly. Something to think about the next time you look up at the night sky.